Bene, buongiorno a tutti, benvenuti al Salone del Risparmio 10ª edizione, benvenuti da parte nostra di MFS e benvenuto anche dal nostro collega Vishal Hindocha che è basato a Londra. Per chi di voi non ci conosce, siamo una società che nel 1924 lanciò il primo fondo di investimento negli Stati Uniti, gestiamo qualcosa di più di 400 miliardi di euro di masse e appunto abbiamo inventato il fondo di investimento nel 1924. Basati a Boston, per cui MFS sta per Massachusetts Financial Services, con più di 1000 dipendenti direttamente in loco, qualcosa più di 150 dipendenti nell'ufficio di Londra e poi abbiamo 3 grossi centri di ricerca e anche di investimento in giro per il mondo. Il tema che vorremmo presentarvi oggi è un tema che è, se così volete, un'analisi ancora più dettagliata, una conseguenza di un qualcosa che abbiamo implementato e continuato a migliorare nell'analisi delle aziende che poi anche aggiungeremo nei nostri portafogli, che è un seguito dell'analisi ESG. Quindi il tema principale di questo salone sono le 3 lettere famose che, come avete visto, tutto il salone di quest'anno gira intorno. Ecco, ESG in MFS non è un prodotto, ESG in MFS è parte della nostra cultura, proprio cercare di capire ogni singola lettera o poi a seconda della società l'una o l'altra lettera quale impatto possa avere nella sostenibilità proprio del modello di business di queste società, proprio per riuscire a coglierne non solo le opportunità ma prima di tutto i rischi. E questi rischi poi tradotti in quello che presenterà il mio collega sono dei rischi che aiutano semplicemente a capire come diversificare al meglio il proprio portafoglio, perché se poi ci concentriamo solo su una di queste 3 lettere o solo su 2 di queste 3 lettere rischiamo eventualmente di non capire non solo i rischi dell'intero mercato ma i rischi di medio e lungo periodo di interi settori. Ecco, quindi in un ambito come quello dell'anno scorso, dove abbiamo visto che la tradizionale diversificazione ha avuto parecchie difficoltà e dove gran parte delle asset class, ahimè, hanno chiuso in negativo e quindi la diversificazione ha aiutato ben poco, se non anzi affatto. Ecco, la presentazione del mio collega Vishal Hindocha baserà proprio su quello. Vish è un membro anche della CFA Society di Londra e quindi ecco, molte delle discussioni che hanno proprio a livello di CFA Society può essere che la diversificazione come l'abbiamo imparata in passato sia ancora attuale, cioè in un contesto di mercato, in un contesto economico dove la crescita attuale mondiale è relativamente debole rispetto al passato e probabilmente avvicinandoci sempre di più anche alla fine di questo ciclo economico, ecco, può essere che questa diversificazione funzionerà anche in futuro? Quindi la combinazione oggi che vi vorremmo dare è quale impatto ha l'analisi ESG, nell'analisi vera e propria poi completa, complessiva di tutte le società nelle quali andremo a investire. Io sarò qui presente, poi Vish presenterà per circa 40-45 minuti, ci sarà una sessione di Q&A alla fine, vi prego di fare qualsiasi domanda perché appunto è un tema un po' al di fuori di quello che si presenta in questi 2 o 3 giorni al Salone del Risparmio e altrimenti poi siamo presenti anche al nostro stand. Grazie, Vishal.
Thank you, Andrea. Welcome, everybody. Thank you for having me here. You may want to listen for live translation. It's such an honor and a pleasure to be speaking in front of all of you today, so thank you for having me. As Andrea explained, my name is Vishal. I work at MFS Investment Management. And at MFS Investment Management, our sole mission is to create value for clients by allocating their capital responsibly. It's with that mission in mind that we really began exploring and expanding on this topic of diversification. And as we unpack the presentation today, you'll see that most of this presentation, I think, will challenge some of your beliefs. It certainly challenged many of mine, many of the things, as Andrea was saying, that they teach you in your first class at the CFA school is about the beauty and benefit of diversification. As you can guess from the title, maybe the evidence is lacking on some of those things. The presentation, I hope, will be very interactive, so I will at points ask you questions. In fact, I'm going to begin now, so just by a show of hands, I would like to see who believes in diversification. So who in their capacity as an advisor or an investor or even in your personal investments has pursued a strategy of diversification. That's nearly everybody in the room. Good. So a room full of skeptics in terms of my presentation today. And it is one of my beliefs. I had my hand up too. It's one of the most pervasive beliefs in all of investment theory. And it makes sense intuitively as well. We're told as very young children not to put all of our eggs in one basket or to not have all of our risk in one place. And yet what we would hope then is there'd be abundant amount of evidence. We'd want lots of data and evidence to say that diversification works, and it works really, really well for investors that want to achieve some long-term outcome. What we find is, as we'll see, the evidence is fairly lacking. But I want to make a couple of points very clear before we dive in. This presentation is not about dismantling diversification or saying that it's useless and shouldn't be used. It's an important part of the investor toolkit. But what we are saying are two very important things. One, we think that alpha is going to have to play a much bigger role in your portfolios going forward. And two, we actually think alpha and skill is the best diversifying asset you can buy today. So that is where I expect you to challenge me at the end of this presentation. There'll be plenty of time for your questions. In most of my presentations, I'm happy to take questions on absolutely anything that you have to ask. I only have one rule today, and that's you're not allowed to ask me about Brexit. Not because I have any inside knowledge, despite this wonderful accent, but because nobody knows about Brexit. So other than Brexit, you can ask me any question you like as we go through the presentation. So, another quick show of hands. We're going to first set the market context and backdrop, but I just wanted to see whether we have a room full of optimists or realists. So, raise your hand if you think the equity return over the next 10 years is going to be higher than equity return achieved over the last 10 years. So, we're going to have a more favorable equity market environment for the next 10 years than the one that we've witnessed so far. Raise your hands if you believe that that's true. Three optimists in the room. Welcome. Well, I think as we will go through, so the purpose of this session is to say, well, where are we in market returns? Should we be expecting as good market returns that we have had over the last 10 years? So this is one of my favorite charts that shows this. This shows a very long history of the US market. We use the US market because it has the longest and richest data set. So this data goes all the way back to the early 1900s. And what we're looking at here is the S&P 500 on bull and bear markets. So looking at periods of growth and periods of drawdown. And what you can see over here in the right-hand side, that's where we have been. You know, almost 10 years of an extended bull run in the US market. Now, what you should say to me then is, well, that's all very well and good, but market cycles don't die of old age. In fact, that's what our chief economist said to me when I showed him this graph. Market cycles do not die of old age, and that's true. One other interesting fact on this chart is you look at the cumulative return achieved for investors, 330%. Almost 10 years to the date. March 2009 is often signified as the beginning of the recovery. So almost 10 years today, we began this recovery. 330%. That's not actually statistically the biggest cumulative impact, even though it is the longest period of a recovery we've had. So we've had quite a shallow recovery. And again, the challenge you should throw at me there is, well, shallow recoveries don't really tell you anything either about when the market will decline. And that's true. So what do equity market fundamentals tell us about where we are and what returns we should expect going forward? Again, this is another one of my favorite graphs. I'll explain it very quickly. Here we're using the price to earnings ratio, the Shiller cyclically adjusted price to earnings ratio. And what we're looking at is on the bottom part of the chart, where the PE is less than 10, between 10 and 20, 20 and 30, etc. What does that mean for equity markets achieved over the next 1, 2, 5, and 10 years? Okay? So we're currently in this region, in the red box here, and what this is telling us that over the next year, if history is any kind of guide, we should be expecting a less than 2.5% annualized return from equity. But nobody can predict what the equity market is going to do over the next year. The more interesting thing with this, again, very long data set, this goes all the way back to 1928, is that when price to earnings ratios are in this level, when valuations are around this level, the 5-year and the 10-year returns look very depressing indeed. So that's equities. What about bonds? What are bond markets telling us about where returns might be over the next 5 to 10 years? Well, one of the great things about bond markets is that the starting yield of a bond often tells you or gives you a very good indicator of where returns might be in 5 years' time. And so that's what this chart shows. So on the bottom, we've got the starting yield, and on the top, we've got the subsequent annualized 5-year return. So each dot represents, and you can see it's actually a fairly good line going up and to the right. The current yield to us is this purple dot here. So we're currently in a zone of 1.77% on a yield to worst. This is on the global aggregate index, so global fixed income markets, which tells you that the subsequent 5-year return should be somewhere between 2 and 4%, again, if history is any guide to the future. So a fairly depressing story for equities and a fairly depressing story for bonds. Why is that? Well, I didn't want to dominate this discussion with lots of macroeconomic talk. So we could have spoken about many, many things. We could have spoken about US and China trade wars. We could have talked about globalization policy. But I did want to bring forward one theme that as investors we are exploring today. So this is one thing that we are very concerned about, and we're doing lots of exploratory work. And that is leverage. Okay, so we're concerned about leverage. The title of the chart is, we're 10 years on from the biggest debt crisis we've seen in a very, very long time. Have we learnt our lesson as investors? Now, the chart here shows you corporate debt to GDP and corporate debt levels for major indices around the world. I could have shown you a chart showing government debt to GDP, consumer debt, corporate debt, or a combination of all three, and they would all show you exactly the same thing. So for the sake of the presentation, I'll leave it here. Suffice to say that where leverage is now is higher than where we were pre-global financial crisis. So 10 years on from the biggest debt crisis the world has ever seen, we've now got more leverage in the system. Now, leverage, again, is necessarily not a bad thing, but what it does is it ups the analytical ante. It means you have to be very, very careful what you own, because leverage can make outcomes very bad very quickly when companies go into distress. But again, leverage in and of itself is not such a bad thing. What if the quality of the bond is better? What if liquidity is better? What if these businesses are better able to tolerate higher leverage? Well, unfortunately, as the leverage has been creeping up, the quality of bond markets and the liquidity available in bond markets has been declining. So we have more leverage at lower quality and much less liquidity as market makers retrench from the market. So that is definitely something that we're thinking about and exploring as we assess company health, as we assess industry and sectors across fixed income and equity. To leave you with this then, so every 6 months we publish our forward-looking long-term market expectations. I won't go through the model and the results. Suffice to say that the purpose of it in the presentation today is the red bar shows you the 10-year forward returns for major asset classes. The grey bar shows you the historical result. Now, in order to be fair and capture a more full market cycle, the historical actually goes back 15 years. Okay, that's really important. So that captures the global financial crisis. So we're not just counting the last 10 years, which would have been off this chart if we'd included that. Now, the main message is that for most major asset classes, and certainly the asset classes that the investors here today are interested in, the red bar is lower than the grey bar on just about every measure. So again, back to the polling question, I think we agree with the vast majority of the room that forward-looking returns from pure markets are going to be much lower than we've experienced over the last 10 years. So, in response to that, and given that we've got a room full of pessimists and people that believe in diversification at this point, another question for you. How many of you have been actively exploring using alternatives in your investment strategies? So just a show of hands, if you've had a conversation about an alternative liquid alpha, private debt, private equity, any of those questions. Someone very proud of it at the back. More and more people getting there. Okay, great. And you are not alone. So this is actually a chart from Callan Associates, a US consultancy. The reason, again, I've shown them is that their data goes back quite some way. So I'll explain what we're looking at here. Their question was, over the last 30 years, how would an investor have had their portfolio arranged in order to meet a 7.5% return target? Apologies if you can't see this at the back. So each of these pie charts represents an asset allocation mix, and all of them are trying to target a 7.5% return target. The great thing about Callan's models is that they go all the way back to 1989. So in 1989, their clients could achieve a 7.5% return with 75% in cash and 25% in US short-dated fixed income. What a wonderful world that must have been to live in. Well, roll the clock forward to 2019, and the pie chart has just got much more complicated, right? We're needing to diversify and move into lots and lots of different types of alternatives in order to meet that exact same return target. The other thing that leaps off the page here is the risk numbers. And again, apologies if you can't see this at the back, but in the beginning, risk was 3.1%, which is unsurprising given it's mostly cash and short-term government bonds. And risk today in their model is 18%. So a 6 times increase in risk, much more complexity to achieve exactly the same result. I do not envy any asset allocators in the room today. So how has diversification been doing? Coming on to the purpose of this presentation. I want to take you back to the UK, to my home market. So in my home market, we have this phenomenon of the diversified growth fund. This is a one-stop shop for diversified growth assets. So skilled, active managers typically putting together baskets of risky assets and selling them in a packaged solution. We've had these funds for about 10 years. They were largely born out of the financial crisis. And investors and trustees, institutions have been investing in these for some time. Most, if not all, diversified growth funds were sold to investors on the premise that they will deliver equity-like return with half the volatility. Okay? Equity-like return, half the volatility. And they were going to do that by pursuing a strategy of diversification. Now, the last 10 years have been a remarkable equity market environment. Very, very low volatility and exceptional secular returns. But those diversified growth funds have actually delivered half the return of the equity market with about equity market volatility. So lots of disgruntled investors coming to us and saying, Vish, help me out here. I don't understand what happened. I invested in a diversified growth fund and they've delivered half the results with as much volatility. I don't really understand what happened. Now, I have to be clear, MFS don't have a diversified growth fund, but I do actually push back to those investors. I say to them, actually, maybe your expectations were entirely incorrect as to what diversification will deliver for you in some of these environments. And we've been in an exceptional environment. So, does diversification work? Often touted as the last free lunch in investing. So we began, as a result of these client inquiries, we began to unpack why is it that diversification has failed investors over the last 10 years. This is an extract from a paper published in the Financial Analyst Journal, that's the CFA magazine, in September 2018. It's written and authored by 2 gentlemen from T. Rowe Price, a competitor, and it's a good treatment of this subject. I'll explain very briefly what they did here, but it's important to understand the consequences. What they did, they said everybody that talks about diversification talks about correlation through time. And correlations are assumed to be static in many of our models. Well, what if we look at what correlation does or what it becomes in very stressed environments? So if we imagine that the equity market follows a normal distribution, what happens in the left tail when equity markets are performing extremely badly? And what happens in the right tail? What happens when equity markets are performing extremely well? So I've inverted the chart, but the top half looks at the left tail event. So this is what's happening when equity markets are performing extremely badly. And what you would love to see if you were a strategist that has pursued a strategy of diversification is those correlations going to 0 or potentially negative. So you've invested in these assets that will deliver something for you when equity markets are challenged. Actually, what we see in those conditional correlations, and again, this data goes back 30 or 40 years, is that correlations very, very quickly get quite high, go to 0.6 to 1 very, very quickly in some of those stressed environments. So the message there, one message there is diversification seems to fail you the second that you need it the most as an investor. But there's another part to the story too. So the bottom half of the chart says what happens when equity markets are doing extremely well. Well, there, suddenly diversification works incredibly well. Nothing keeps up with equities in a raging bull market, it seems. So the moment that you don't want any diversification is the moment that it rears its ugly head and brings your portfolio down with it. So everywhere we go and we hear these trustees say the same thing, I ask, how are you feeling about markets? And they say, a lot like this room. We think the recession is coming or the correction is coming soon. What we're going to do is pursue a strategy of alternatives and diversification, and that way we'll get equity-like return with less volatility. Well, history has shown us that that has not worked, and to them, I offer the Albert Einstein definition of insanity. His definition of insanity was, of course, that doing the same thing again and again and expecting different results is his definition of insanity. I'll go back to that in a second. But it's not just to lay the case for why diversification doesn't work. Like I said at the beginning, I think diversification is actually an important part of the investor toolkit. It just needs to be done appropriately. And one of my favorite principles, actually a Warren Buffett principle, is the Noah principle. This idea that predicting rain doesn't count, but building arcs does. So where do we go from here, and how do we solve this ever complex problem? So I want to set you a small challenge, if you'll humor me. So I think you were given pen and paper when you walked through the door. If you could get those in your hand now. And I'd love you to draw this grid as best you can on that piece of paper. I'm going to set you a small challenge just to show you how hard it can be to solve what seems like a fairly trivial problem as it gets more and more complex. Okay? This won't take more than a minute. Hopefully you've got a pen or a piece of paper somewhere. You may even be able to draw it on your phone. Okay, I'll get going. So, once you've drawn that grid, so we want 4 squares in a grid and the black shaded squares in 3 of them. We're going to start in this square over here in the top right. And I'll give you 5 seconds, and you've got to divide the white space into 2 equal parts. Okay, dead easy. This is the easiest one. It's going to get harder and harder. So, in the next 5 seconds, once you've drawn that, please divide that space in the top right into 2 equal parts, the white space into 2 equal parts. Raise your hand if you've got that correct. A few of you? Okay, great. Yeah, easy, very easy. Just a straight diagonal line from there to there, splits those 2 and 2. We're going to move anti-clockwise now, so we're going to the top left. I'd like you to divide that space into 3 equal parts. Okay, so getting slightly more complicated now. Time's up. Hands up if you've managed to achieve that. Still got a few people in the game. Getting more complicated. Bottom left. I'd like you to divide that into 4 equal spaces. I'll give you 5 seconds. This is tricky because you're not using regular shapes anymore. Hands up if you've managed to get that. We've got 1 over there, so we've got 1 or 2 people left. Last one. I'd like to divide that space into 7 equal parts. Can you divide that into 7 equal parts, please? I'll give you 5 seconds. Done? How many people managed to achieve that one? 1. So, if I had started with a blank piece of paper and asked you to divide it into any number of shapes, what you would have done is very simply take your pencil and draw lines down the top of the page. So actually the last one is by far and away the easiest one to divide into 7. But what I had done is anchor you to think that the solution had to be more and more complex as you went through, right? We went from diagonal lines to squares. The answer here is actually L-shaped, so you start with a square like this and divide the rest of the shape. And then you were convinced that to do 7, to get from 4 to 7, needed to have a much more complex outcome. And this is not unique to the people in this room. It's well documented, and one of my favorite books is a book called Black Box Thinking. It's written by a gentleman called Matthew Said. And this book deals with how industries, individuals, societies learn from failure. Do they learn from failure, or do they ignore it and keep making the same mistakes again and again? This has nothing to do really with the investment industry at all. In fact, he talks more about the healthcare and aviation industries as examples. But in there was a paragraph that I thought was really, really powerful as I was unpacking this diversification argument. And here he says that everyone falls into these 3 traps. Right? experts get very fixated on a narrow solution. The experts in the room got fixated on making that problem more and more complicated than it needed to be. The second one, less relevant for us today, but no one's willing to challenge the hierarchy. This idea of diversification is taught by some of the most leading academics and is in all of our literature. So no one wants to challenge something that's been laid down as economic law. But the third one, and perhaps the most important one for today, is that once experts are narrowly fixated on that solution, they lose sight of the original goal that they were intending to solve. Right? They lose sight of what it is the problem we were going to solve. And my contention is that that is what's happened with diversification in markets today. We're overcomplicating portfolios. But again, back to the Noah principle. How do we solve from here? So let's go back to first principles. What kind of return do you actually need? What return do you or your investors need to achieve over time? I would argue that most risky assets follow a fairly normal distribution, and what you'd want is the return expectation in the middle, and you know as seasoned investors that you have to tolerate some risk. There's going to be some risk around that central expectation. That's what those red lines there signify. Now, you'd ideally like to be on the right-hand side of this distribution, i.e. getting more return for the risk that you're taking, but you know that you have to accept sometimes you will slip into the left-hand side. But over the long run, as long as you maintain space within that distribution, you should be able to achieve the outcomes that you and your fiduciaries need you to achieve. Well, then the second question is, how can you achieve those outcomes, right? What tools do we have, again, in our toolkit to achieve those outcomes? So one is absolutely diversification, right? What diversification does is it changes the shape of the distribution. What we should expect it to do is essentially tuck in the tails. The right tail and the left tail should come in as we have exposure to different asset classes doing different things. Perhaps the data that we've just shown you suggests that it's more like this. And you unfortunately get a lot more of the bad outcomes and a lot less of the good ones through time, but suffice to say, it changes the shape of the distribution in that way. There's two other things in your toolkit. One is active management. If you get active management right, which is a big if you get it right, it should change the skew and shift the distribution to the right-hand side. So if you get a good active manager, you should expect to get better than average outcomes, and my contention here is good active managers will protect you more in the downside than they will necessarily outperform in the upside. So again, that shape and skew of the distribution has changed. To complete the toolkit, you have option strategies. Option strategies are used by some types of investors. They're typically expensive. The question mark here refers to the fact that you can draw just about any distribution outcome that you desire. But again, they usually come with a premium or a cost in most market environments. So now we've said, well, we want to achieve this result. How are we going to do that? And I think, realistically, the answer is going to be some combination of these three things. I do think, though, that the amount of money and energy and interest going into alternatives and diversification is overdone, and perhaps people are overlooking the quality that active managers can play in being a diversifying asset for you when times are bad. Now, I've shown you lots of data on why diversification doesn't work. I've shown you no data on whether active management works or not. So the next two slides cover those things. So one way that we looked at this, and this is an ongoing project for us. So I'll explain these graphs very briefly. In the green on the left-hand side, you have the two most recent bear markets, the two most recent recessions. On the right-hand side, you have the two most recent bull markets, so the two ensuing bull markets. So in the top left, you've got the dot-com bust. Then you move to the right-hand side. That's the pre-global financial crisis period. Then you've got the global financial crisis. And then you've got the period to today. And what we're looking at here is the count of managers in the eVestment database. So about 600 names in this database over those time periods. And we're looking at how they performed. So on the x-axis here, that line there is 0, and then you've got 7+% over here for 143 managers in the dot-com bust. So here we're trying to say, is there any evidence to say that active management does indeed shift the skew of the distribution? Do active managers tend to perform well when equity markets are having a tough time? So this would suggest, and it's not complete by any stretch of imagination, but this would suggest that they do. This would suggest that actually the results are largely skewed to the right-hand side. in bear markets, active managers tend to outperform. What happens in bull markets? Well, there you see a much more normal distribution. And in fact, you see that over the last 10 years, active managers have really struggled to keep up with passive over that period of time for many reasons that are well documented. So there is some evidence that this actually does change the skew. By the way, this is done in large cap US equity. We've replicated this for global equity, European equity, emerging market equity, fixed income, and the results are very much the same. So just for brevity, I've included the one with the most data in there. And do top quartile or median active managers actually outperform rising and falling markets? So another way of looking at that. Now, the reason I bring this out is that in falling markets, even the median active manager is outperforming by about 1%. Right? So again, does it change the skew and the shape of the distribution? I think it does. I think there is some evidence that suggests that if you can find the better than median active manager, yes, you should expect better than average outcomes, and you should expect a diversifying property from skill. So, is there a better way? So one fund that you will have heard us talk about, many of my colleagues at the MFS booth will be talking about, is prudent capital. I bring up prudent capital because when those trustees in the UK and in Ireland ask and say, have you got a DGF that actually delivers? I say no, because we don't necessarily believe that that's the way to do it. But I will show you prudent capital. Prudent capital is concerned with preserving capital and incrementally growing it. Right? It's based on many of the theories we've talked about today. Nothing outperforms equity in a raging bull market, and cash is the only thing that doesn't go down when markets are under stress. So the investors spend all of their time thinking about trying to identify high quality, really undervalued companies, that contrarian skill. And they're not afraid to sit on cash or use options to protect themselves when they feel that the market is rich. So this is a strategy that I think for investors concerned with diversification or worried about equity market risk, this is potentially one way in which you might solve that. Many of the arguments we've made, by the way, don't necessarily pertain to a particular type of skill. Many of you will know MFS are fundamental bottom-up managers. We can express skill in different ways, and this is just one of them. But prudent capital, I think, is an interesting strategy for people to consider if you are worried about diversifying away from equity market risk, but you still need to generate that excess return. So, to conclude and to open up for questions, I think alpha is going to have to play a much more important role in your portfolios going forward. You are not going to get the market returns that you've achieved over the last 10 years. And my contention here, and I'm happy to take questions on this, is that skill, and in particular counter-cyclical skill, is the best diversifying asset your clients can buy today. So with that, I'd like to thank you and open up for questions.
Good job, Vish.
Thanks.
Grazie mille, siamo più che disponibili per approfondire questo discorso, questa presentazione, e quindi se avete domande approfittatene qui, e poi più tardi saremo anche presenti con Vish per qualche ora ancora al nostro stand. Domande? Diversificazione, come si è visto, è un tema molto sentito che ha sempre funzionato in passato, però come avete potuto sentire dalla presentazione, la combinazione da aspettative di crescita economica da un lato inferiori per il futuro, dall'altro lato valutazioni relativamente elevate, la distorsione dei mercati dovuta alla forte liquidità ha alimentato, diciamo, un po' tutte le S classi in questi ultimi fantastici 10 anni. La realtà dei fatti la si è vista l'anno scorso, quando appunto questa liquidità tutta a un tratto è scomparsa, ed è scomparsa un po' da tutte le S class, quindi la diversificazione non ha funzionato. Stiamo cercando, ecco, di darvi un input di come tutti questi fattori che partono dall'ESG, che partono proprio da capire quanto sia sostenibile un modello di business di una società, ci permetta di acquistare questo titolo per un lungo periodo, che è tipico di MFS, proprio, diciamo, nel nostro DNA cercare di analizzare meno la parte macroeconomica, molto di più la parte microeconomica, per cercare quelle società d'eccellenza che ci permettono veramente di aggiungere nei portafogli per voi e per i vostri clienti e quindi diciamo di diversificare il portafoglio stesso, di ridurre al tempo stesso il rischio, e questo ad esempio con ottimi risultati dei nostri portafogli l'anno scorso. Ciò nonostante, come si è visto, diciamo, gran parte di queste S class appunto hanno avuto grosse difficoltà nei momenti difficili, ed ecco che in un'aspettativa più o meno, come si è vista, ottimista da parte vostra, da parte dei vostri clienti, spinge a rivedere un po' quello che è la definizione di diversificazione storica. Ecco, vorrei chiedervi se avete appunto qualche domanda per il nostro collega, la signora.
Buongiorno, si sente sempre più dire ultimamente che sarebbe meglio investire con lo stile value e non più con lo stile grow. Voi cosa ne pensate?
Grazie. So the lady was asking if in recent times you hear more and more people asking if value investing could be a good answer instead of investing just with a growth style. So it's more a matter of style. Do you think that value investing could eventually do better?
That's a great question. So the question is about value versus growth and whether value has a time and place right now. Is that fair? I think this is a really difficult one to answer. We definitely get that question a lot. Every day I get at least 10 questions on whether value should now come in favor or whether growth is on a secular trend. I think it's really challenging for two main reasons. One, as you have probably gathered by now, I'm a big fan of Warren Buffett and many contrarian investors. So I do fundamentally believe that value investing, identifying a small number of really high quality companies, is the best way to compound wealth over the very long term. What we've seen in the growth market, though, is you have this phenomenon of the technology industry in particular taking off. And it's hard to know when that will end, when that exuberance will end. I think, to answer your question directly, I think both need to have a role in the portfolio, but I do think that value has been underused for so long. And most investors, as we look through some of their portfolios and we help them understand their style biases, most investors are overexposed to growth just because of the market drift, just because of the phenomenal performance of some of the growth stocks in their portfolio or the growth strategies in their portfolio. So I do think more and more investors are looking at value-based strategies today. Does that answer your question?
This might sound like a bit of a mean question, but you said that top quartile active managers outperform also in falling markets. So where is MFS positioned in the falling markets, and what's the average outperformance in that same graph? If you would have to draw like a data point for MFS, where would it be?
Sure. So it's a good question. MFS, I'll very quickly explain how we build portfolios, because it's not as easy a question to answer. So we have many different types of strategies, but there's one common theme about how we invest. Okay, so we believe, obviously, we're a pure active manager, so we believe the market is inefficient somewhere. We believe it's inefficient at quality, valuation, and patience. Okay, so we're very long term. We want to pay for high quality businesses, but we want to be very price disciplined about doing that. Now, what that means, what that quality and patience discipline especially means, is what you expect from most MFS portfolios, not every MFS portfolio, is that we protect capital really well in those down markets. So the global financial crisis was one of the best periods of outperformance for MFS. So we would be in that top quartile for most of our strategies. If you think about global equity or European equity or certainly something like prudent wealth or prudent capital, through some of those more stressed market environments, are performing really, really well and protecting that capital. We tend to keep up when markets are going up too. So I don't have it here, but in some of our literature, we show you what quarterly performance looks like and whether it's an up market or a down market or somewhere in between. So if the market's down more than 5% on the quarter, if it's between -5 and 5%, or if it's up more than 5%. And we tend to have more outperformance we have outperformance across all of them, but we have much more outperformance in that down market. And I think one of the reasons for bringing this out is I think alignment is an incredibly important thing for us at MFS. and understanding that actually what investors care about more is not necessarily keeping up when equity markets are doing 30% per annum, but protecting capital when equity markets are down 50%. Right? The best way, Barnaby Wiener, who's the portfolio manager on Prudent Capital, says that the best way to make money is not by losing it is by not losing it in the first place. Right? So if we can keep what we have and incrementally grow it over the long term, we are going to beat the market.
And I think, Vish, just referring to your last point and to Prudent Capital as a fund, I think also the mod from our side, cioè quindi il nostro messaggio per quest'anno, ma soprattutto per gli anni a venire, è principalmente legato a, si può usare una frase, è proprio vincere evitando di perdere. Quindi focalizzatevi sempre di più su capire proprio i rischi nei vostri portafogli, cercate di diversificare i vostri portafogli, ma appunto come si è visto non è così facile. Quindi una componente quale può essere ad esempio il cash può diversificare veramente perché è l'unica asset class in teoria che non perde e soprattutto vi permetterà di poter riacquistare a prezzi inferiori quando il mercato poi vi offrirà questa opportunità nelle più svariate asset class. Quindi questo è il nostro messaggio finale. Dal nostro punto di vista grazie mille per essere stati con noi, siamo più che disponibili nel nostro stand sia per approfondire il discorso di fondi, di questa soluzione in particolare e poi se avete voglia anche abbiamo una piccola attrazione con una piccola gara di macchine, quindi siete più che benvenuti. Grazie ancora e buona giornata.
Thank you very much. Thank you.
Great job.
Thanks.
staccare?